Welcome to another episode of Healthy, Wealthy, and Wise Retirement Podcast, where certified financial planner Lauren Sherman shares thoughts on having a healthy mind, body, and spirit, an abundance of wealth inside portfolios and out, and lessons learned from clients and mentors over the years.
Welcome back, and thanks for joining me for another Healthy, Wealthy, and Wise Retirement. Of course, I am your host, Lauren Sherman, and today we are going to talk about finding peace of mind during not-so-peaceful market conditions. Depending on when you are listening to this, it's possible the market has already fully recovered and it once again feels like smooth sailing. If that's the case, that's great news, but the market never goes up forever, at least not without some pretty good dips along the way, or even all-out recessions like we appear to be heading into here in the summer of 2022. So while today's talk may be topical for our current market environment, I encourage you to use the 7 principles we will talk through today during any market conditions, and particularly revisit them during future market turbulence. Let's start out with a quick story of George and Judy's summer vacation to Wisconsin Dells. George and Judy loved going to the water parks with their 3 kids, but this trip would be different, as all 3 were finally tall enough to ride the roller coasters. While Judy was excited to experience each ride with the kids, George had other things on his mind. He wanted to be sure he had a strong Wi-Fi connection wherever he went, as the stock market had been tumbling downward and he was monitoring everything from his phone. If things continued to get worse, George planned to sell off more of his stock, and if it looked like the market was recovering, he wanted to be ready to jump all in. Of course, he had already done this several times, mistakenly thinking that we had hit the bottom, and other times mistakenly thinking that we were in full recovery mode. As George was finding out, the market does not move in a straight line. So while George was staying close to the concession stand where the Wi-Fi was strong, Judy ventured out with the kids to see how many roller coaster rides they could get in before dark, as there were several throughout the park. After only about an hour and a half, George was surprised to see Judy and the kids walking back to the concession area. "What happened?" he asked. Judy said, "Well, looks like we have to stick to the water park this year. We only got through 2 roller coaster rides, and each time, the kids loved the slow ride up with the beautiful views of the park." Judy continued, "But even though they were all tall enough to ride, they just weren't ready for that steep drop back down each time. They were all too scared to continue, and they were a bit frustrated that I kept trying to get them to give it one more shot." "Well, that's pretty silly," exclaimed George. "The kids have to get over this fear. Roller coasters can't just go straight up." To which Judy replied, "On another note, how are things going with you? Have you figured out this market yet?" George answered, "It's been pretty frustrating. Each time the market starts to recover and I get back in, then it promptly goes back down. I'm worried that we may just need to move everything to cash and wait until this all blows over." Of course, the irony of this story is pretty obvious. The kids wish the roller coasters would just go straight up without any drops, and George wishes the stock market would do the same. Unfortunately for George, he can only see the absurdity of his kids' actions, but not that of his own. At the end of the day, fear and frustration had taken over them all. So how do we find peace of mind during unpeaceful markets? Would George have been better off doing nothing at all? Which, as funny as it sounds, often doing nothing can be the toughest thing to do. I will share my thoughts and let you know some of the actions we are taking for our clients as I talk through 7 principles to follow during uncooperative markets. Hopefully this can help you find some peace of mind, and you may even be able to follow a few of these action steps yourself. Number 1, my first principle is probably the most important, and it will come as no surprise if you've listened to many of my past episodes. And that's simply to maintain a focus on what we can control. It seems obvious, but it's always worth repeating. There is no sense to dwell on things that we have no control over, or have no intention of doing anything about. When we stay the course and stick to our plan, we're actually widening the gap between us and others who react emotionally. Doing nothing is not always the solution, but we also cannot minimize the impact of remaining steadfast and having the courage to stick to our plan. This brings up another point. If you do not have a plan, and this is something you've always pushed down the road thinking that it wasn't urgent, now is the time to take action and get started. There are some do-it-yourself ways to get a plan started, or you can hire a financial planner to help you. Many will charge a one-time fee or perhaps a continual fee to manage your plan on an ongoing basis. They should not require you to sign up for a product or even manage your assets to do this. If you seek the help of a financial planner, it may not hurt to check out a previous episode called 12 Questions to Ask Your Financial Advisor, as this gives you a good framework if you decide to interview multiple advisors. As always, I will link any resources I talk about today in the show notes so you can easily find them. Sticking with the theme of focusing on what we can control, another action step that we can take is to review your risk tolerance. People answer risk-related questions differently depending on their mood in that moment, how well the market is performing at that time, and any number of other variables that can change. It's worth double-checking your risk number, or however you check your risk tolerance, to make sure your portfolio is still aligned. The way our firm goes about this is to send you an assessment link that walks you through a series of questions. Some of the questions are more emotional in nature, while others deal with hard and fast numbers. But once complete, we end up with 3 separate numbers. One number represents your risk tolerance, which is simply a measure of how much risk you are comfortable with from an emotional standpoint. The second number represents your risk capacity, which essentially shows us how much risk your portfolio can handle from an analytics perspective without any emotional considerations. And the third and final number is a measure of where your current portfolio is as of now. So as an example, your risk tolerance and capacity numbers might be 21 and 24, and your current portfolio might have a risk number of 25. That's a pretty well aligned portfolio, as you don't have to match them up exactly. On the other hand, you might find that your first 2 numbers are close, but your portfolio is 10 or more points off. In these situations, there are some easy steps that you can take to get things back in order, or perhaps align them for the first time if you've never gone through this exercise. So we've talked about a couple of action steps that you can take related to our first principle of focusing on what we can control. The first was to stick to your plan or set one up if you don't have one yet. The second was to align your portfolio with your risk number. There are plenty more that we could add to this list, but let's close out with just 2 more action steps. Our third is to review the cost of your portfolio. This includes everything from advisory fees to expense ratios and perhaps many more costs that are sometimes out of sight, out of mind. You could have an independent advisor review your portfolio costs for you, or you could hop on a service like that of Morningstar to double-check costs on your own. If you know the ticker symbol of your investments, which is the 3 to 5 letter abbreviation, you can type this into Morningstar or even Google and find the expense ratio and other fees like a sales load. If your fees are on the higher end, you will likely want to bring those down. But with that said, you need to be aware of tax and other considerations, so this is not a project you want to take lightly. The fourth and last step that we will cover today relating to our first principle is to review the diversification of your portfolio. In that same way that your risk number can and will change, your portfolio or your pie chart won't look the same as it did when you started investing. Let's say you have a proper balance of stocks, bonds, cash, and alternatives. Of course, within these, we may have short, mid, and long-term investments, large and small companies, domestic and international, and over time, some of these asset classes will perform better than others. When some perform better, your pie chart now consists of more of that asset than those that did not perform as well. This can particularly be the case in times of market volatility, where it's easy for your pie chart to get out of whack. So our last action step of this first principle is to reevaluate your portfolio and rebalance back to your ideal pie chart if needed. Let's move into our second principle, which is very much related to our last one, and that is to change your perspective. Now, I may not be talking to all of you for this principle, but the tendency during unpeaceful market conditions is to let our perspective trend a little negative. In fact, funny timing, as I was finishing up writing this episode, we were at Hope Church Sunday morning and Pastor Scott Rains was sharing some facts about the amygdala and how part of its job is to take in our life experiences and determine if the experience and the information is worth storing away for later, or if it's unimportant. And by using MRI technology, what they've been able to determine is that 2/3 of the neurons of the amygdala are used to detect negative experiences. Only 1/3 of the neurons are used to detect positive experiences. I share that as a reminder that it's only natural to trend a bit negative during tough times, so we can't be too hard on ourselves if this is the case. I also don't want to undermine the real impact that tough market conditions can have on families and individuals. But with that said, the fear of a recession and the fear of market drops can often do more damage than the actual recession or drops themselves, especially if we are reacting emotionally. I've found that stories and visualizing things can help make the concept stick. So let's talk through a few images that can help reinforce positive perspectives. First, I've shared this before, but it's worth repeating. Imagine yourself walking up a flight of stairs with a yo-yo in your hand. The flight of stairs represents the long-term outlook of how markets have historically performed. But as we take each step, the weekly, monthly, and even yearly results could look much more like the yo-yo bouncing back up and down. By zooming out and focusing on the stairs rather than the yo-yo, we can worry less and have more confidence. Another image, particularly one those in the Midwest might appreciate, is to picture yourself out on the tractor planting your seed for the year. Do you stew and fret over every seed you plant, worrying that some are not going to grow into the corn, beans, or whatever crop you're planting that year? Or do you simply understand that you have to go through the process to harvest your crop in the fall, and it's not only okay, but it's expected that not every single seed is going to turn into something? We can think of the market in a similar way, as markets tend to go up over time, but that's not going to be the case every year, just like not every seed is going to yield something upon harvest. In the same token, imagine yourself rolling dice. If they land on 1 through 4, you lose. But if they land on 5 through 12, you win. How many times would you roll those dice? With only 4 losing numbers and 8 winning numbers, my guess is that you would roll them as many times as you could. A similar story was shared with me that really stuck for some reason is to think of a weighted quarter. Instead of landing on heads half the time and tails the other half, this quarter is weighted and it lands on heads about 6 or 7 times out of 10. How many times would you flip that quarter if you could have heads each time? Once again, if we know that the market tends to go up more than it goes down, would we want to be a part of it? Sure, it can be frustrating because real results are more sporadic, but just like the roll of the dice, the flip of a weighted coin, or trying to guess which seeds are going to sprout into something, we can still maintain confidence that the numbers work out over time. Let's cover a couple more perspective shifts that may be helpful. One that I'm fond of saying is that markets are not doing something, they've only done something. We can confuse ourselves by the language we use. We might say, the market is going up, or the market is heading down, both of which refer to something in the future. We are better off, and quite frankly, more accurate, if we think and speak in terms of what has already happened instead of what could happen or is happening. This helps keep us focused on what we can control, which leads into another perspective shift, and that is to focus on your number of shares, not the share price. In a perfect world, if you are instead focusing on your goals, objectives, and what you want your retirement to look like, that would be ideal. But for those who like to track the numbers a bit more, keeping the focus on your number of shares can be helpful. Unless we are taking income directly from this particular account, we can shift our attention to maintaining or even adding more shares to our portfolio and trust that the value will go up over time. Another thought regarding our perspective comes from the great investor Warren Buffett, who declared, "Be fearful when others are greedy, and greedy when others are fearful." Personally, I would edit this a bit to say, "Be steadfast when others are fearful," as this is when the market provides plenty of opportunity. And last, I will finish this one up about changing your perspective with the advice Pastor Scott Rains shared with us, which is to spend time recounting what you are grateful for. Pay particular attention to how you've been blessed and all of the positive experiences in your life. Let's move into our third principle, which is to arm yourself with facts rather than fear. Watching the news or market commentary is rarely, if ever, helpful, as fear sells much better than positive news. Even when we know this to be true, we can't help but get sucked in when we listen to negative messages repeated on our TVs, newspapers, and computer screens each day. It's funny, really, as we all have access to more information in the palm of our hand with our smartphone than we could find in even the largest library. More information is not the problem. It's discerning it and making correct decisions with it that separates the bad from the good and the good from the great. Put a little bit more bluntly, using another quote from Warren Buffett, "When the tide goes out, you see who is swimming naked." I'll leave that one alone, as you'll have to seek out Mr. Buffett if you want more details. When it feels like we are in the eye of the storm, I think it's helpful to zoom out. So let's look at the past 100 years, of which we've had 15 recessions. When averaging those out, that is about one recession every 7 years. We already start to have a different perspective if we look at it through this lens, as market dips and even recessions are part of the process rather than an aberration that we need to avoid or be scared of. Looking at those same 15 recessions over the past 100 years, what if we started investing the day each recession began? First off, what bad luck with our timing, right? But if we look at how the stock market performed for the next 10 years after each recession, so again, this is going back to 1928, and we had bad timing because we started investing the day each recession began. During that 10-year run following each recession, the market averaged an annualized return of 7.85%. While 7.85 is a little shy of the market's return in general, that's not too shabby. Let's look at another fact to be aware of. With all of the doom and gloom talk that can take place, and trust me, you can find plenty of doom and gloom chatter when the market is in a recession because the person taking this perspective can always see signs of things getting worse. On the flip side, during a bull market, the same doom and gloom person can see all of the signs as to why it cannot continue and why we are overdue for market losses. Even in times when the market has been level without gains or losses, there are 1,000 different reasons that our doom and gloom crowd can point to for an upcoming recession. Whether it's inflation, our national debt, foreign issues, our political climate, there is always enough ammunition to give the doom and gloom group plenty of reasons to worry. I got a bit sidetracked there, but the point I started to make is that despite all of the doom and gloom outlooks, the market has never not returned and surpassed its previous high. I'll repeat that because it's a good mantra to think of when anxiety is high. The market has never not returned and even surpassed its previous high. Of course, past performance is no guarantee of future performance, but the outcome has been the same over and over throughout our country's history and throughout many tough and challenging times we've faced. Let's move into our fourth principle to keep in mind during unpeaceful markets, which is to take advantage of tax-saving opportunities. If the market has dropped and we expect it to eventually recover to previous highs, then this is a great time to pay less on our Roth conversions and use tax loss harvesting to our advantage in our taxable accounts. With a Roth conversion, we are taking tax-deferred money and converting it into tax-free money. Sure, we still have to pay taxes on the conversion, but we can pay less when asset prices are depressed. Roth conversions are not something to indiscriminately do on your own, as they require keen attention to detail. As I've mentioned in previous talks, altering one tax consideration could impact several others. For a visual, it can be a little like knocking down a domino. Even if you only make one move, you might start a chain reaction that affects a few more. So that's not to scare you into avoiding this strategy. It's just a word of caution to be aware of if you are doing this on your own. With tax loss harvesting, this allows us to offset gains within our portfolio and even offset $3,000 of taxable income each year. I used this same example in my tax harvesting episode, so I will link that in the show notes for reference, but let's use George and Judy again to illustrate this. George and Judy have a properly diversified portfolio, and because of this, each year they have some investments that are winners and some that are losers. Investment ABC went up from $100,000 to $115,000 for the year. Investment XYZ, on the other hand, had a tough year, going down from $100,000 to $80,000. George and Judy have the option to harvest on both sides here. Their $15,000 gain can be offset with their loss. Additionally, they can offset $3,000 from their income tax. And last, they still have a $2,000 loss left over that can be carried forward to future years when needed. So what happened here is that one investment went up $15,000 while another went down $20,000. Instead of paying taxes on the $15,000 gain, George and Judy were able to tax loss harvest and bypass any taxes on that $15,000 gain. After doing this, they still had $5,000 of losses to use because remember, the loss was $20,000 to start with. They used that $3,000 to offset their tax income. This is the maximum allowable amount. And the last $2,000 that was left over, they got to carry that forward to the next year to repeat the process again. This is a powerful strategy that can always be used in taxable accounts, but it has its most leverage during a recession or after steep market drops. Moving on from tax opportunities, our fifth principle is to independently review your insurance. Double check that you have the proper coverage while also reassessing if you have any coverage that is no longer needed. Of course, this could be done at any time, but it becomes even more important to review expenses during challenging market conditions so that we are not withdrawing more than we need to from our portfolio. We don't want to overstress a portfolio if we don't have to. One quick note here too is that we said to independently review your coverage. If you simply review things with your current carrier, it's far less likely that you will be offered a lower rate or better coverage. Your home and auto coverage would certainly fall under this category, as there are often opportunities to improve, particularly if you haven't had any claims recently. Life insurance is another important coverage to review. People are living longer and longer, which means insurance companies update what is called their mortality tables. If you have life insurance and you haven't updated it for a handful of years, there's a good chance you are not getting credit for the lengthened mortality tables in your policy. There are a few other insurance coverages that offer routinely reviews for clients, but to keep this moving, let's head into our sixth principle. This one relates back to our previous message of follow your plan, but it's worth specifically focusing on. So our sixth principle is do not attempt to time or beat the market. To hear all of the details about why this doesn't work, you will have to check out our episode titled Timing the Market. But in short, this leads to added stress, reduced returns, and another full-time job in retirement. What often happens is that investors feel most comfortable when the market has been great for a period of time, and psychologically, they are unprepared for market turbulence. Of course, the flip side is that people often panic or become most distressed when the market has struggled, but brighter days are ahead. So it's often natural to have these feelings that all of our money should be in the market when it's been cruising and put everything on the sidelines when it has struggled, particularly to the point of recessions. But it does not behoove us to chase gains or hide from turbulence. Remember, when we try to beat the market, we have to make two decisions. Let's say we are worried about the market and believe it will go down, so our first decision is when to sell. It's hard enough to get that part right, but then we also have to get the second part right of knowing when to buy and get back in. As obvious as it may sound, the market rebound will not be announced in advance. There is no alarm bell that goes off to notify us. We need to remain invested to catch the rebound, particularly since such a large percentage of gains happen within only a handful of days. If we look at the past 15 years leading up to 2022, the market returned close to 10.5% annually. If we missed just the 10 best days over that 15-year span, our return gets cut in half. If we miss the 20 best days over those 15 years, our return drops all the way down to 1.59%, and we may as well have kept the funds in a bank account. So this is where a lot of people get frustrated. They get conservative and sit money on the sidelines until it feels safer, but then they miss out on those best recovery days. Of course, this is where it can feel a little bit like a roller coaster, where we feel comfortable at the top, so we get in, and we feel frustrated at the bottom, so we get out, and our timing could not be worse. The problem that this data reflects is that the market trends only look obvious when we have the power of hindsight. I promise you, it's as clear as mud while you are experiencing these market fluctuations in the moment. So I just wanted to highlight that again, as there are some action steps that you can take during uncooperative markets, many of which we've discussed today, but timing the market is not one of them, and you will likely end up putting yourself in a tougher position. Let's move into our last principle for handling unpeaceful markets, and that is to be aware of inflation. Maybe I could have picked a better title for this one because, of course, everyone is aware of inflation, but it's worth considering what has been hit the hardest by inflation, and maybe what hasn't been impacted as much. For example, obviously gas has gone up dramatically, so driving a little less, carpooling, and other strategies for travel could have more of an impact than spending money elsewhere that hasn't been hit as hard. Along with considering inflation, this is a good time to review spending and reassess goals. It's a good habit to go through all of your expenses from time to time and reevaluate where your dollar goes. Don't spend money on something just because it's what you've always done. We should be asking ourselves questions like, does it still bring us joy? Is it still worthwhile? Are there comparable alternatives that would work just as well or have a similar impact? While there are plenty more great questions to consider on our attached inflation checklist, rather than repeat them here, I will let you check out that resource for yourself, as it's already formatted for you to print off and check yes or no for each question. And once again, you can find that linked in the show notes. So with that will do it for our list today. For a quick rundown of our 7 principles again, we had first, focus on what we can control. Second was to change our perspective by focusing on the positive and remembering that markets tend to go up over time. Third was to arm yourself with facts rather than fear. Fourth, we covered taking advantage of tax-saving opportunities. Fifth, we talked about the importance of reviewing your insurance coverage. Sixth, we reiterated that it's important to avoid the desire to time or beat the market. And seventh, we included a checklist in the show notes titled, What Issues Should I Consider When Dealing with High Inflation? We had a lot of action steps in today's episode, so be sure to check out the cheat sheet for a condensed list that you can easily reference. That's all I have for you today, but please reach out with any feedback, questions, or to let me know what topics you'd like to hear covered in the future. Also, check out healthywealthywiseretirement.com for all of my past episodes, and stay tuned for a new episode coming in just 2 weeks.
Thank you so much for listening and supporting this podcast. If you've enjoyed listening, we would love if you took a quick moment to leave an honest review. Of course, we're shooting for 5 stars, but if you have suggestions to improve the show, we would love to hear from you too. Just click on the podcast name, Healthy, Wealthy, and Wise Retirement Podcast, and scroll down to ratings and review. Thanks again for your support, as this helps us reach a wider audience and help even more retirees just like you. This podcast is for entertainment and informational purposes only and is not intended as a specific tax, legal, or investment advice. Lauren Sherman is a certified financial planner and co-owner of Integrity Wealth Management, an investment advisor serving retirees in search of their own healthy, wealthy, and wise retirement lifestyle.